Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. In today's episode, we'll start studying everything related to inventory, because this is going to be one of the most important financial elements of most companies that are buying their inventory from some supplier and then want to resell it. So we can start considering important things about inventories. So for example, you usually want to sell it fast, you want to collect the receivables fast, but you would usually like to pay slow. So this is going to imply that a lot of money is moving throughout the company around the inventories, and that all of this is going to connect many factors, such as the credit sales, the cost of goods sold, and even the raw materials or other purchases that you're doing. But let's start with the inventory's definition according to financial accounting. Inventories have three characteristics. They are assets that first are held for sale, and this is going to mean that they are finished goods. You already have them finished and you only want to sell them. Second part of inventories would be those that are in the process of production, and they're going to eventually be converted into the ones that are held for sale, but these ones are usually called the work in progress inventory, or WIP. The third and last form of inventories are going to be the materials or the supplies that you are going to use for the production of the inventories at the end. These are called raw materials, and it's usually summarized as RM. So, three things can be considered inventories: finished goods, work in progress, and raw materials. So how are all of these ones going to be interconnected? Basically, because of the costs that you're taking from producing one to another stage into another stage. So in today's episode, I want to give you small hacks and tips to summarize how all of these ones are usually moving throughout a company's inventory position. First, you have to consider the raw materials, because these ones are going to be the ones that you buy initially for producing more inventory. For calculating your raw materials, you should always start with the raw materials that you had at the beginning of the period, and then you're going to add to that the raw materials that you've purchased right now, which seems pretty simple. I had raw materials, I purchased a couple raw materials, and then lastly, we would just take away the raw materials that you used because you won't have them anymore. Those are going to be transformed into the work in progress part. So first equation, very easy. Raw materials at the end of the period will be raw materials at the beginning of the period plus raw material purchase minus the raw materials that were used. Now, all of these raw materials that were used are going to go to, obviously, the work in progress. I'm already using them, so it's switching up to second category. And for calculating the work in progress, you always have to start with the initial amount that you have, but we're going to add that value that we just got from the raw materials used. So we have initial work in progress inventory plus the raw materials that we used, and then plus all of the conversion costs. And this part is going to be crucial because we'll include the labor, the overhead, the utilities, even the depreciation will be added up here. So work in progress will cover lots of costs, but they will all be added for calculating the value of this type of inventory. And the only thing we have to take away, similar to when we took away the raw materials that were used, here we'll take away the goods that we already produced. because these ones won't belong anymore to our work in progress category. They will go up to the finished goods. So again, let's summarize this equation. Work in progress at the end of the period would be initial work in progress plus raw materials used plus all of the conversion costs minus the goods that you produced. Now, let's switch up to the last and third part of the inventory. These are going to be the finished goods. And as you can guess, you already have most of the parts of this equation already in your head, because for calculating them, you have to start with your initial finished goods, and we're going to add all of the goods that were produced from our work in progress that was completed. Lastly, the only thing we'll subtract from this one, it's going to be the cost of goods sold, commonly referred to in accounting as COGS or COGS. So after you have that, you have a value for the finished goods. And this ones will be the end inventory finished goods. But so, as you can imagine, this is not a static process in companies. Many companies are usually buying throughout the year, producing throughout the year, and then having finished goods for sale throughout the year. So how can you calculate the exact costs that are associated with the inventory that you have? Well, the truth is there are 4 ways of doing it. So you can do valuation in the method that best suits your company, but you will have to know that all of these methods will either change the costs of that inventory that was sold, but also the amount of inventory that you have left. So all of this one will have different implications when it comes to reporting. Let's start looking into each one of those 4 methods. The first one is called FIFO, or first in, first out. And what this method wants to say is that you'll usually start selling first the things that you bought first. So if we imagine a hypothetical situation where I am selling cakes, and I bought a couple cakes at the beginning of the year for $10. Then 2 months later, they were charging $12 because of inflation. And then in the middle of the year, they were charging $15. When I'm reselling them, how should I calculate all of these costs? We are going to assume that the first ones that I got are going to be the first ones that left. And this will be extremely used in, for example, perishable foods or supermarkets that usually do this product inventory. So the first thing they receive is the first one they'll take out because you can't accumulate all of these things. They're going to be perishable. And so the ones that I bought for $10 at the beginning of the year were the ones that were sold. And let's say I want to calculate the amount that I have left, I would only take the last ones that I bought because first in were the first out. But there's a trick to this. You could also do it the other way around. And this is only allowed in US GAAP standards. This is not allowed in other companies' valuation methods, but this one's called the LIFO. So last in, first out. Let's imagine again another hypothetical situation. I'm selling soap. So I just bought soap at the end of the period, and I want to calculate that soap that I just bought at the end of the period is the one that I first will sell. Last in, first out will take the exact opposite from first in, first out. So you'll calculate the remaining amount of inventory you have with the initial amount that you bought, not with the last one. So these two are going to be related, but they're going to be opposites. Now, for me, the easiest way would be to use what some companies use, and it's the specific costs. So you can track things and you can know which one costs you what. The hard thing is, how can you track inventory so good? Not many companies have the capacity to do this. That's why usually you're using either first in, first out, LIFO activities, or also the weighted average, which is the fourth and last option. The weighted average will basically, as the name says it, create an average of all of the costs from the goods that you had. So now, let's say, going back to my cake example, I won't have my first cakes by 10 or 15. I'll just create a weighted average of how many cakes did I buy, multiplied by 10, how many cakes for 12 did I buy, and those multiplied by 12, and like that. You'll get a weighted average, and then you'll divide it by the total amount, and you'll know approximately how much each one of those costs. All of these methods, as I said, are valid. It will depend on your company to calculate through using one method or the other, but you do have to consider that using different methods will change your cost of sales amount and also your remaining amount of inventory. So it will have an effect in the assets when it comes to valuation. Now, I want to finish up my episode by including other remarks that are important when talking about inventory. And first is, which costs are we going to include? I was telling you that inventory that we buy includes the raw materials and all of these things. But one rule of thumb that you can consider is that we're going to include any cost required to get the inventory ready to be used. So costs included in the inventory should be, for example, the purchase price, the transportation price, the duties, and even the conversion costs, such as direct labor or fixed and variable overhead. There may be some abnormal costs related to this inventory by probably waste or underutilization, but these ones cannot be included in the inventory because those costs weren't needed for the inventory to be ready. Lastly, you also have to think that the indirect or period costs are expensed. So this may imply, for example, storage costs or the general administrative costs. One of the costs that you have to watch out for is the depreciation expense that will be hiding in the inventory and will only appear in COGS when it's sold out. And so why am I talking about depreciation if inventory isn't really depreciating? Basically because the cost of the things that you're using to produce that inventory, so let's say the cost of property, plant, and equipment, or your factory are going to be embedded in that inventory. And this will happen because that factory is adding value to your own inventory.